President Trump just signed an executive order that, in my view, should make every serious investor stop and think about what is really happening underneath the surface of the retirement system. Most people will hear about it as a new account, some people will call it a political idea, some will argue about whether it is fair. But that is not the most important thing. The most important thing is that it changes the plumbing. And when the plumbing of money changes, the effects rarely stop where people think they will stop. This new account is being described as a Trump IRA. It is being presented as a way to give ordinary workers access to retirement investing when they do not have a 401k at work. That sounds simple. That sounds helpful. And for many people, it may be helpful. But I have learned over many decades that when governments create a new pipe for money to flow through, the question is not only who benefits directly. The better question is, where does the money come from? Where does it go? Who gets diluted? And who owns the assets that receive the flow? That is how systems work. In a system, every action creates a second-order effect. And second-order effects are where most people get hurt or get rich. So I want to walk through this calmly. I want to show you why the old 401k system has real weaknesses. I want to explain what this Trump IRA is trying to solve. Then I want to show you what most people will miss, which is how this can affect the stock market, the government deficit, the value of the dollar, inflation, and the opportunity set for people who understand how money really moves. Because the biggest mistake most people make is that they only look at the surface. They ask, do I get the account? They ask, do I get the match? They ask, can I invest $5? Those are useful questions, but they are not the deepest questions. The deeper question is this. If the government creates a new retirement account and then puts money into it, what assets will that money buy? If millions of people who were not investing before now become buyers of stocks, what happens to demand? If the government does not already have the money to fund those contributions, what happens to debt? And if debt rises and money is printed or borrowed to fill the gap, what happens to the purchasing power of wages and savings? That is the chain. And if you can see the chain, you can make better decisions. Let us start with the 401k because you cannot understand what is being replaced or bypassed until you understand how the existing system works. A 401k is a tax-deferred retirement account offered through an employer. In plain language, you work, you earn income, and if your employer offers the plan, you can put part of your income into this investment machine. That money can be invested over years or decades, and while it is inside the machine, it receives certain tax advantages. There are different versions. A traditional 401k lets you contribute money before paying income tax on it. Then you pay taxes later when you withdraw the money in retirement. A Roth 401k is different. You pay taxes before the money goes in, but then it can grow tax-free and come out tax-free. If the rules are followed, the concept is good, the purpose is good. You take money that might have been spent today and move it into productive assets for the future. You use time and compounding. You build retirement wealth. That part is not the problem. The problem is that the 401k system is not available equally. If you work for a company that offers a strong plan with low-cost funds and an employer match, you may have one of the best wealth-building tools available to an ordinary worker. But if you drive for an app, work part-time, work for a small company, work as an independent contractor, or hold a job that does not provide a plan, you may not have that tool at all. And the Trump administration is pointing at that gap. The argument is simple. A great number of Americans do not have access to a 401k through work. If retirement wealth is mostly built through workplace retirement systems and many workers are outside that system, then those workers start behind. That is the access problem. There is also the fee problem. Many people do not understand fees because fees look small when they are written as percentages. 1% sounds small, 1.25% sounds small. But in long-term investing, small-looking fees become large because they compound against you for decades. This is one of the most important lessons in investing. Compounding can work for you, but fees compound against you. If your account compounds for 30 years and a percentage of it is skimmed every year, the total cost is not just the fee this year. It is the fee this year, plus the lost growth on that fee, plus the lost growth on all future fees. That is how the system quietly extracts wealth. According to the argument behind the Trump IRA, the average 401k carries fees that are much higher than many people realize. Some funds may be cheap, some plans may be excellent, but many people are not in excellent plans. They are in plans with layers of costs, limited choices, and funds that can charge far more than a simple low-cost index product. The Trump IRA is being presented as a way to cap those fees. Instead of a plan where a worker might pay more than 1% in annual fees, the Trump IRA would cap fees at a much lower level. Around 15 basis points. 15 basis points sounds like a detail. But details compound. If a person invests $500 a month for 30 years and earns an 8% return before fees, the difference between a high fee and a low fee can be enormous. In one case, a large part of the final account balance is lost to money managers. In the other case, most of the return remains with the worker. That is why fees matter. Not because they make headlines, because they silently decide who keeps the compounding. Then there is the portability problem. A 401k is tied to an employer. If you leave one job and go to another, you may be able to roll the plan over. But many people do not do it. They leave accounts behind, they lose track, they get stuck in old plans, they make mistakes. The system becomes fragmented. A portable account is different. If the account is tied to the worker rather than the employer, then the worker carries the structure from job to job. In theory, that makes retirement saving easier, especially for people who change jobs often or work outside the traditional employment system. That part also makes sense. Then there is the minimum problem. Many financial systems are designed in ways that quietly exclude people with very little money. They require minimum contributions, minimum balances, or a level of consistency that is difficult for a worker living paycheck to paycheck. If a person can start with $5, the psychological barrier is lower. That may sound small, but small habits become large systems when they are repeated across millions of people. So on the surface, the Trump ERA is a response to four real problems: access fees, portability, minimums, and then the most emotionally powerful part is the government contribution. This is the part people will hear first. If a worker qualifies under the income rules, the government may contribute money into the account. The full contribution could be up to $1,000 a year if the worker contributes enough of their own money and stays under the income limits. For a single person, the full benefit would require low income. For a married filer, the threshold is higher. Then the benefit phases out as income rises. The structure is essentially a government match, not an employer match, a government match for workers who never had an employer match. That sounds powerful. And for some individuals, it is powerful. A 50% match on the first dollar saved can be an excellent incentive. If you put in $2,000 and the government contributes $1,000, that is a large, immediate return on your contribution before any market gains occur. So if you only look at the individual worker, the idea can look attractive. But I do not stop there. I ask the next question: where does that $1,000 come from? This is where the conversation changes, because there is no free money in an economy. There is only money whose cost is hidden, delayed, transferred, or diluted. That is a principle. The government does not have a magic source of wealth. It has tax revenue, it has borrowing, and it has a relationship with the central bank and the monetary system. If the government gives money to one group, it must get that money from somewhere. It can tax, it can borrow, or the monetary system can create the dollars that allow the borrowing to continue. Each path has consequences. The United States government already spends far more than it receives in tax revenue. A rough way to think about it is this: the government may collect around $5 trillion in taxes and spend closer to $7 trillion. The gap is not small. It is measured in trillions. That gap is filled with debt. The government borrows the difference. It borrows from individuals. It borrows from institutions. It borrows from foreign buyers. And indirectly, when necessary, the Federal Reserve can become part of the funding system by creating money and buying or supporting government debt through the broader monetary framework. This is where people must be very careful. When a government already runs large deficits and then creates a new program that costs money, the question is not whether the program feels good. The question is whether the system has the capacity to fund it without creating more debt, more inflation, or more pressure on the currency. If taxes are not raised and spending is not cut elsewhere, then the program must be funded by more borrowing. And if borrowing increases in a system already dependent on large deficits, the risk is that the currency becomes diluted over time. This is not ideology, this is arithmetic. You can print money, you cannot print wealth. When more dollars are created without a proportional increase in real goods, services, productivity, and wealth, each dollar has less claim on the real economy. That is inflation. Inflation is not just higher prices. Inflation is the decline in the value of the unit you are paid in. And that is why people who rely only on wages and savings often fall behind, while people who own assets often move ahead. The asset owner may benefit when new money flows into financial assets. The saver may suffer when the purchasing power of cash declines. So now we have two forces at the same time. One force pushes more people into investing. The other force may require more government borrowing or money creation. Both forces can raise asset prices, but they do not help everyone equally. This is the uncomfortable part that many people do not want to discuss. if the government encourages or subsidizes investment into the stock market. And if the government must borrow or print more to do it, then people who own productive assets may benefit while people who do not own them may lose purchasing power. That is the system. It is not always fair, but it is how the machine often works. And if you want to protect yourself, you cannot only complain about the machine, you have to understand it. Now let us talk about the stock market impact. Markets are driven by many things, but one of the most basic forces is supply and demand. If there are more buyers than sellers, prices tend to rise. If there are more sellers than buyers, prices tend to fall. This is true for houses. It is true for gold. It is true for cryptocurrency. It is true for stocks. If a new retirement account causes tens of billions of dollars to enter the stock market over time, that is new demand. It may not move everything immediately. It may not prevent bear markets. It may not stop recessions, but it changes the flow, and flows matter. Every major retirement structure in modern America has changed market flows. The 401k did, the IRA did, the growth of low-cost brokerage accounts did, the rise of automatic investing did. When millions of people put money into funds every paycheck, they create a steady bid under financial assets. Not every day, not every month, but structurally over time, this Trump IRA, if it works as described, becomes another channel for money to enter the market. That means more buyers. Some of those buyers will buy broad total market funds, some will buy SP 500 funds, some will buy default portfolios, some will buy what the government or plan structure allows. But the basic effect is that more retirement dollars are directed into financial markets. That is why financially savvy people pay attention. They are not only asking whether this helps the worker, they are asking where the new flows go. And if you understand where money is flowing, you can position yourself on the right side of it. This is not about predicting next Tuesday. It is about understanding incentives. If the government creates a system that pushes more dollars into the stock market, then owning pieces of the stock market may become even more important. That does not mean buying blindly. It does not mean markets only go up. It does not mean there will be no crashes. In fact, more access and more money can sometimes increase volatility when more people enter markets. Prices can rise faster during good periods and fall harder during panic periods. Free money can create excitement. Excitement can create excess. Excess can create crashes. Crashes can create opportunities. That is the cycle. The mistake is thinking the system gives you a straight line. It never does. The system gives you cycles. And if you understand cycles, you stop treating volatility as a surprise. You expect it. You prepare for it. You use it. That is why market crashes create wealth for people who have liquidity, discipline, and a long time horizon. When assets are sold in panic by people who are overleveraged or frightened, disciplined buyers can acquire good assets at better prices. But you cannot do that if you do not understand the system. And you cannot do that if you are forced to sell when fear is highest. So when I look at this new retirement structure, I see two things at once. I see a tool that may help workers get into the market, and I see another mechanism that could increase debt, increase money flow into financial assets, and reinforce the divide between those who understand asset ownership and those who only work for wages. That is why this matters. Now let us go deeper into the fee issue because it is one of the easiest parts to underestimate. Suppose a person invests $500 per month for 30 years. Suppose the account earns 8% before fees without high fees. That can become a meaningful retirement balance. But with an average fee around 1.26%, the worker can end up with far less. A large amount that could have stayed in the account is instead transferred out of the account year after year. Many people think the difference between 1.26% and 0.15% is about 1 percentage point. That is technically true, but in long-term investing, it is not 1 percentage point. It is decades of compounding being redirected. A low fee does not guarantee a good outcome, but a high fee creates a headwind that must be overcome. And the more ordinary the investor, the more important this becomes. A wealthy investor may have access to tax planning, private funds, professional advice, and customized structures. But a low-income worker may have only the account, the contribution, and time for that worker. Costs must be low because time is the asset. The Trump IRA is trying to make that cost problem smaller, and if it does, that is meaningful. But again, low fees do not solve the entire system. They solve one problem inside the system. The larger question remains funding. Let us say millions of workers qualify. Let us say many of them contribute enough to receive a government match. Let us say the government sends money into those accounts year after year. That money is not neutral. It must be financed. If the government already has a deficit, then either the deficit grows, taxes rise, spending falls elsewhere, or the monetary system absorbs more pressure. The most politically difficult options are raising taxes and cutting spending. The politically easier option is borrowing more. And over time, borrowing more can become money creation through the broader system depending on who buys the debt and how the central bank responds. That is where inflation enters. People often think inflation is only caused by one thing. It is not. Inflation can come from supply shocks. It can come from demand. It can come from energy. It can come from wages. It can come from money and credit creation. But when the government repeatedly spends more than it takes in and the gap is filled by debt and money creation, currency debasement becomes a real risk. This is why I always think in terms of cause and effect. If the government spends more money, somebody receives it. If somebody receives it, they spend or invest it. If it is invested, asset prices may rise. If it is funded by new debt, future obligations rise. If it is funded by money creation, the currency may lose purchasing power. If the currency loses purchasing power, savers lose and asset owners tend to win. That is the chain. It is not emotionally satisfying, but it is clear. Now, let us think about the investor's practical problem. If you are an ordinary person, what do you do with this information? You do not control fiscal policy. You do not control the Federal Reserve. You do not control whether the government borrows $2 trillion or more. You do not control whether this new account begins in 2027 or changes later. You control your behavior. You control whether you learn the rules of the game. You control whether you own assets or only hold depreciating dollars. You control whether you understand fees. You control whether you build liquidity. You control whether you panic when markets fall. That is where power is. The simplest way to participate in the American stock market is through broad ownership. A total stock market fund gives you exposure to thousands of companies. An S&P 500 fund gives you exposure to the largest publicly traded companies in America. These are not magic. They will go down. They will disappoint you at times. They will make you feel stupid in bear markets. But over long periods, broad ownership of productive assets has been one of the most reliable ways for ordinary people to participate in economic growth. If more money is being directed into the stock market over time, then owning productive assets becomes even more important. Again, I am not saying that means rush in blindly. I am saying understand the direction of the flow. Money that stays in cash can be safe in nominal terms but unsafe in purchasing. Power terms, money invested in assets can be volatile in nominal terms but may be safer over long periods if the currency keeps losing value. That is one of the great paradoxes of finance. The thing that feels safe can make you poorer slowly. The thing that feels risky can protect you over time if held properly and sized properly. This is why most people struggle. They confuse volatility with risk. Volatility is movement. Risk is permanent loss, forced selling, bad structure, excessive fees, bad behavior, and not understanding what you own. If you have a long time horizon, low-cost diversified exposure, and the emotional discipline to hold through cycles, volatility may become the price you pay for long-term compounding. But if you are over-leveraged, underprepared, or speculating without understanding, volatility can destroy you. The same market can be an opportunity for one person and a trap for another. The difference is not the market, the difference is preparation. This is why I like to think in principles. Principle 1, understand the structure before you react to the headline. The headline is New Retirement Account. The structure is new flow of money into financial assets funded by a government that already runs large deficits. Those are not the same thing. Principle 2, follow the money, not the slogan. The slogan is access, fairness, and free contribution. The money flow is workers contributing, the government matching, funds buying assets, deficits expanding, and asset prices potentially receiving another source of demand. Principle 3, there is no free money, there is only money paid by someone now, someone later, or everyone through inflation. Principle 4, low fees matter because compounding is fragile. Every unnecessary fee is a leak in the machine. Principle 5, if the system rewards asset ownership, you must learn asset ownership. You may not like the system. You may think it is unfair, but the system does not care what you think. It rewards the people who understand it and punishes the people who ignore it. Now, I want to be careful about one thing. It is easy to hear a program like this and become too optimistic. It is also easy to become too cynical. Both are mistakes. The optimistic mistake is to think this will solve retirement for everyone. It will not. A $1,000 government match can help, but it does not replace income discipline, saving, investing time, and good behavior. If a person contributes only a tiny amount and then stops, the account will not change their life. If a person invests badly, chases hype, pays unnecessary costs, or panics during crashes, the structure will not save them. A good tool used badly can still produce a bad result. The cynical mistake is to say the whole thing is meaningless because the government is borrowing anyway. That is also too simple. Even in a flawed system, incentives matter. If a person who never invested before starts investing because the match gets them started, that can matter. If low fees keep more compounding in their account, that can matter. If portability keeps people from losing track of retirement money, that can matter. Systems can be flawed and still contain useful tools. That is why intelligent decision-making requires nuance. You do not have to worship the policy. You do not have to hate it. You have to understand it. Then you have to decide how to operate inside the environment it creates. Now let us talk about the inflationary impact more plainly. If more government money is put into retirement accounts and that money is financed by additional debt or money creation, the average person may face a strange situation. They receive help investing, but they also live in a world where prices rise because the currency is diluted. So the person who uses the account to buy assets may be partly protected. The person who does not use the account may simply experience the inflation side. That is how these policies often widen the gap. The person who owns assets benefits from the flow. The person who does not own assets pays through purchasing power. That is why financial education matters so much. If people do not understand the mechanism, they may think the government is giving money away for free. But if they understand the mechanism, they realize the real question is whether they are using the money to buy assets that can preserve or grow purchasing power over time. The match is not the end. The asset ownership is the point. Now suppose this account channels new money into broad market funds. What companies benefit? The companies inside the funds. If money flows into total market funds, thousands of companies receive demand for their shares. If money flows into SP 500 funds, the largest companies receive the strongest structural bid. This is one reason large public companies have become such powerful wealth magnets. Retirement systems, index funds, pensions, and automatic contributions create continuous demand for their equity. That does not mean every valuation is justified. It does not mean every stock is cheap. But it means that financial plumbing can support asset prices in ways that people who only read headlines do not understand. A stock market is not just a place where people pick companies. It is a system of flows, retirement contributions, institutional allocations, corporate buybacks, government policy, central bank liquidity, household savings, foreign capital. All of these flows interact. When you understand that, you stop asking only, is the market high? You start asking, what is the structural demand behind it? And when a new retirement channel is created, structural demand changes. Again, not perfectly, not immediately, not without risk, but structurally that matters. Now, what about volatility? If this program increases participation, it can also increase the emotional component of markets. More people investing does not automatically mean more rational investing. Many new investors buy when prices feel good and sell when prices feel terrifying. This creates opportunity for disciplined people. If markets crash after years of new money entering, many weak hands may sell, but the long-term owner with cash and discipline can buy assets at lower prices. This is why I do not fear crashes the way many people do. I respect them, I prepare for them, but I do not treat them as a reason to avoid asset ownership. In a system where currency is diluted over time, avoiding all assets because they can fall is often more dangerous than owning assets with a sound plan. The danger is not the crash. The danger is being unprepared for the crash. If you have no emergency fund, you may be forced to sell. If you borrowed too much, you may be forced to sell. If you bought assets you do not understand, you may panic. If you invested with money you needed in the short term, volatility becomes dangerous. But if you have a plan, crashes become part of the plan. That is a very different psychology. So if I were thinking through this as a regular investor, I would not ask whether this Trump IRA alone changes everything. I would ask how it fits into the existing pattern. The pattern is that governments create incentives for people to put money into financial assets. The pattern is that deficits continue. The pattern is that money is borrowed and sometimes effectively created. The pattern is that cash loses purchasing power. The pattern is that asset owners, despite volatility, tend to be better protected over long periods. The pattern is that people who do not understand money fall behind and then blame the system. And sometimes they are right to blame the system. But blame does not build wealth. Understanding does. This is the reality of the economic machine. Wages are paid in currency. Currency can be diluted. Assets are claims on productive capacity. Claims on productive capacity can rise when currency is diluted. This is why owning productive assets is not optional for people who want to protect their future. It is not about greed, it is about survival inside a monetary system that changes the value of money over time. Now let us bring this back to the 401k comparison. The 401k helped millions of people build retirement wealth. It also created a massive pool of automatic market demand. It made ordinary workers owners of financial assets. But it also tied many workers to employers and exposed many people to fees they did not understand. The Trump IRA, as described, attempts to open that channel to more people, lower the cost, make it portable, reduce minimums, and create a government match for lower-income workers. Those are real design differences. But the larger macro implication is that the government may be creating another permanent bid for the stock market at the same time it is already running large deficits. That combination is powerful. It can be good for asset prices. It can be bad for the dollar's purchasing power. It can help investors. It can hurt savers. And it can make financial knowledge more important than ever, because if the government gives people a new investment account, but people do not understand what to buy, how fees work, how inflation works, and why volatility is normal, then many will still make bad decisions. Tools do not replace judgment. Accounts do not replace principles. Government matches do not replace discipline. So the opportunity is not merely to open an account. The opportunity is to understand the entire system. If new money is moving toward the stock market, you want to understand broad equity exposure. If inflation risk is rising, you want to understand purchasing power. If deficits are expanding, you want to understand debt and money creation. If fees are being capped, you want to understand how costs affect compounding. If markets become more volatile, you want to understand liquidity and buying when assets are on sale. That is how a serious investor thinks. A serious investor is not just excited because the government offers $1,000. A serious investor asks whether that $1,000 is a small part of a much larger shift. I think it is. Because retirement systems shape markets, and once a retirement system becomes embedded, it can last for decades. Think about automatic payroll deductions. Think about index fund flows. Think about employer matches. Think about target date funds. Think about the way money enters markets every 2 weeks without anyone making an active decision. Those flows have transformed the market over time. A new government-linked IRA could be another flow, and in markets, flows become facts. Now, let me say clearly what this does not mean. It does not mean the stock market is guaranteed to rise. It does not mean you should put all your money into one fund tomorrow. It does not mean there will be no recession. It does not mean inflation will explode overnight. It does not mean the Trump IRA will operate exactly as described forever. Policies change, rules change, thresholds change, markets adapt. But the direction of the idea is important. The government is trying to expand retirement investing to people outside the 401k system. That means more people may become market participants. That means more money may enter financial assets. That means the economic system may become even more dependent on asset prices. And when a system becomes dependent on asset prices, policymakers become more sensitive to market downturns. That has been true for a long time. It may become even more true. This creates a feedback loop. More people own stocks through retirement accounts. Falling stocks hurt households. Policymakers respond to protect confidence. Liquidity returns. Asset prices recover. People learn that markets rebound, more people invest, the system deepens. But feedback loops can also create bubbles. That is why risk management still matters. You do not want to be NFA. You want to be informed. You want to own assets, but not in a way that can destroy you. You want exposure to the system, but not blind dependence on one outcome. You want to benefit from money flows, but still survive when the flow reverses. That is the balance. Now, what should a person actually examine in their own life? First, look at fees. If you have a 401k IRA, brokerage account, mutual fund, ETF, or any retirement product, know the expense ratio, not vaguely. Exactly, if you are paying high fees, ask whether those fees are producing better outcomes. If they are not, those fees may be quietly stealing your compounding. Second, look at access. If you do not have a workplace plan, study what retirement accounts are available to you. A lack of employer access should not mean a lack of ownership. The person who waits for a perfect system often loses years of compounding. Third, look at behavior. The best account in the world will not help if you stop investing when markets fall. You need a process that works when emotions are bad. Fourth, look at purchasing power. Do not measure wealth only in dollars. Measure it in what those dollars can buy. A savings account that rises slowly while prices rise faster is not protecting you. Fifth, look at the direction of policy. If policy is pushing money into markets, understand that. If policy is funded by debt, understand that. If policy may increase inflation, understand that. If policy rewards asset ownership, understand that. Because the people who understand policy flows often benefit before the people who only react to policy headlines. This is why I always return to the same idea. Do not be passive in your understanding. You can be passive in your investment vehicle. You can own broad, low-cost funds. You do not need to trade every day. You do not need to predict every move, but you cannot be passive in your understanding of the machine. The machine affects you whether you understand it or not. Now let us bring the story home. The 401k system had three major weaknesses: high fees in many plans, limited access for millions of workers, lack of portability when people change jobs. The Trump IRA is being designed to address those weaknesses. It is available to workers who do not have a 401k. It caps fees at a low level. It follows the worker rather than the employer. It allows very small contributions, and for people under income limits, it provides a government contribution that can act like a match. That is the first layer. The second layer is that this creates more money flowing into the stock market. If the government and workers are both contributing, that money becomes demand for financial assets. Demand can support prices over time. The third layer is that the government does not currently have extra money sitting around. It already runs deficits. So additional spending must be financed. If it is financed through debt and money creation, it can contribute to inflation and dollar dilution. The fourth layer is that inflation hurts workers who only hold cash and wages, while asset price inflation helps people who own assets. The fifth layer is that the financially savvy investor understands this and positions accordingly. That is the whole system. And once you see it, you cannot unsee it. So the question is not whether this new account is good or bad in a simple political sense. The question is whether you understand the flow. If money is moving into assets, you need to understand assets. If government deficits are expanding, you need to understand debt. If money is being created, you need to understand inflation. If fees are being reduced, you need to understand compounding. If market volatility rises, you need to understand buying opportunities. And if the system rewards ownership, you need to become an owner. That does not mean reckless speculation. It means thoughtful participation. It means learning the rules. It means keeping costs low. It means staying diversified. It means maintaining liquidity. It means investing consistently. It means using downturns instead of fearing them. Most people will argue about the name. They will argue about the politics. They will argue about whether the government should do this or should not do this. That is not where the money is. The money is in understanding the mechanism. The mechanism is this: a new retirement pipe may be opening, money may flow through it, the flow may go into stocks, the funding may add to debt, the debt may add to inflation pressure, inflation may weaken cash. Asset owners may benefit, non-owners may fall behind. That is what serious investors should be studying. Because in the end, the world does not reward the people who are most emotional about money. It rewards the people who understand how money moves. And if this new system begins in 2027 as described, it will not just be a retirement account. It will be another signal that the American financial system is becoming even more dependent on asset ownership. You can ignore that, you can complain about that, or you can learn the machine and act with principles. I would rather understand the machine. I would rather own productive assets. I would rather keep fees low. I would rather be prepared for volatility. I would rather use policy flows than be surprised by them, because the greatest risk is not that the system changes. The greatest risk is that the system changes while you are still operating under old assumptions. And that is why this matters. The 401k may not disappear, but a new channel may be forming beside it. And when a new channel forms, the people who understand it early have an advantage, not because they can predict every detail, but because they can see the direction of the flow. And in investing, seeing the flow is often the beginning of seeing the opportunity.